Hey guys, hope you all are doing good today. In today's video, we'll be looking at a very sensitive topic called risk management. Okay, risk management is by far one of the most important topic when it comes to trading or investment. But a lot of people don't talk about it. It is very important because it has to do with emotions. Okay, we human beings are emotional beings, and we know that a lot of actions, when being taken out of emotions, tends to not go the right way. So it is very important to always try to manage our emotions, especially in terms of investing. We can't avoid emotions, but the only thing we can actually do is to manage them. Okay, so it's always very important to develop a strategy in terms of investing in order to be able to manage your emotions. So in today's video, we're going to be looking at all of that. Okay, so before we proceed, I would like you to take note that everything I'm actually saying here today is strictly for educational purpose. Okay, so most of the things I'm actually going to be saying is strictly to teach you and not to advise you on how to manage your own finance or any of that. Okay, so if you want to seek out financial advice, you can actually look for a financial advisor that's going to put you through on how to manage your own finance. Okay, so let's say we're trying to manage this our emotions now. Okay, so that it doesn't affect the way we see investment, or it doesn't affect our investment. So the best way is to always manage emotions, especially when it comes to investing, is to always invest what you can afford to lose, and to always have it at the back of your mind that anything can happen. It's not like, okay, your house rent is actually due in a week time or in a month's time, and you know that that is the money that you're going to be using for your house rent, and then you actually use it to invest in cryptocurrencies, especially in cryptocurrencies that are very risky assets. Okay, so when you invest with your house rent, you know that yes, now emotion is actually in play. What you actually be after is how to quickly multiply the money. Okay, you might not be able to make rational investment. Okay, but when you're actually investing with money that you know that yes, this money is a money that you can actually afford to lose at the moment, it will allow you, or it will help you make rational or good investment. It will take away emotions from the investment. So I'll take for instance here now, this is like a main portfolio of your investment, your entire investment. I really don't know how it is, but I'm just using this to illustrate an example. Okay, so this is let's say we have the real estate investment. We already know that real estate investment is a less risky investment. Okay, so you actually want to be investing more on the less risky investments. Okay, so let's take for instance, we're actually giving real estate investment here about 40% of our entire portfolio, and then we're giving crypto investment let's say 10 to 15%. Okay, because it is a risky investment. But the advantage about a risky investment is that the riskier it is, the higher the returns. Okay, so let's say if you're investing 10% of your entire portfolio on crypto, okay, then you'll be expecting, like, let's say in the end of the year, you might be expecting to triple or 4x the money, or even 5x the money. Okay, it is risky, but it has a higher returns. But if you're investing 40% of your entire portfolio on real estate, you already know that it is less risky. Okay, that means the returns will be lower. So if you're investing 40% of your entire portfolio, you might be getting let's say 10% of your investment in a year. It all depends. I'm just using this to illustrate an example of how risky investments will give you a higher returns than less risky investments. Okay, so let's say we're actually investing the remaining 20% into business corporation, or starting up our own business or thereabout. And then we're investing the remaining 25% on other forms of investment. I'm actually using this to illustrate to you that cryptocurrency is a risky investment, and that you should always invest what you can afford to lose. That is why I'm actually using about 10 to 15% of your entire portfolio. So let's come down to crypto now itself. Let's take for instance your 10% of your entire portfolio is $10,000 now, which is an example. Okay, so let's say you're investing 60% on spot accounts. We already talked about sports trading earlier, and we talked about how to buy and sell. and then you're investing the remaining 40% into futures trading. Okay, you want to use the remaining 40% in trading your futures trading, which is, it is more risky because you'll be using the leverage, which is like the 10x, 5x, and all of that to optimize your profits. So you have to factor in a lot of possibilities before choosing to go in with probably 30% or 40% of your crypto portfolio on futures to trade. So the way you're preserving your capital on futures is more like the same way you'll be doing for the spot market as well. Okay, so I'm actually using the futures account as an example now because we'll be mostly trading the futures market. So out of your $10,000 portfolio, since you're actually giving out 40% to your futures trading, which will be $4,000 now. Okay, so the next thing we're going to be looking at on how to preserve capital is that cryptocurrency is risky, or trading is risky, very risky, and that you will lose. Hey, let me just take that back. What I'm trying to say is that you will lose some, you will win some. So trading is more like a game of probabilities, meaning that you might, take three different trades and they will all be in profit. And then you might now take two different trades again and then lose. So the market will not always go our way. Our work is to always make sure that yes, we have a strategy in entering the market and then exiting the market. Okay, so we have a strategy. When we enter the market with the strategy and then the market starts going the wrong way, we already have a strategy to exit the market. So there are three different important things you need to know before entering into the market. One is a strategy that you've tested and is working, and the second one is an entry position, while the third one is an exit position. If you don't know the three of them, or if you don't have the three of them in place, you should never ever enter a trade. Okay, if you don't know the strategy that you've actually seen that, oh, okay, you analyze the market and then you see that yes, the strategy you actually have in place is going to go well with the analysis you just did. Okay, then before you enter the market, you already know your entry point. Okay, you already know where you're going to take your profits, and then you already know where your invalidation is. Invalidation meaning that once the market starts going the other way around, you cut down on your loss. I see that a lot of traders don't use stop loss, whereas stop loss is very, very, very important because once you enter a trade and then the trade start going against you, a lot of traders will not even place a stop loss, thinking or hoping that the trade will reverse and start going the other way around or start going their way. So the next thing we really need to know is risk per trade. How much are we going to be risking, or what percentage of our futures account are we going to be risking per trade? Since we already know now that the market will not always go our way. Sometimes we can actually take two different trades and then it will actually end up at an invalidation, or it will go the other way around, not in our favor. So imagine that you're actually using 20% of your account, 10% of your account, okay, and then you just lost two different trades. That means you've actually lost 20% of your entire account in just two trades. It doesn't make sense. And we already know that yes, we're actually trying to take out emotion from our trading. We don't want to be emotional when we're trading and then feeling bad, feeling moody, or crying, or doing all sort of, you understand? So we actually want to take out that emotion. So the recommended percentage to risk in every trade is actually, some experts will tell you 1%. Okay, some will tell you 2%. But I think the recommended percentage to risk is 2 to 3%. So if you're using 2% of your account on just one trade, for you to blow up the entire futures account, you need to lose about 50 different trades, which will 100% be unlikely. Okay, because one of the most important things is to preserve capital. Capital preservation is one of the most important things in trading. You see that a lot of people actually venture into trading, but at the end of the day, they give up or they don't last. Even there's a study that out of the 100% of people that go into trading, I think about 10% to 5% of people are the ones that actually end up making it. Okay, the rest 90 to 95% quit. The reason is because of capital preservation and risk management. A lot of them don't follow any form of risk management. They just enter into any different trades and then use probably 10% of their account or 20% of their account, which at the end of the day, they won't last. They will end up giving up, thinking that this is not for them. Well, obviously, it's probably not for them. So in order for you to last as a trader, okay, or in order for you to last trading the crypto or any market, you need to learn how the risk management and capital preservation actually works, okay? And the best way to understand it is just risking what you can afford to lose in every trade, in each trade rather, okay? And 2% of your portfolio, your entire portfolio, is a very, very good way to start. Even 1%, it all depends on you emotionally. You need to first of all factor in yourself, okay? If you're risking 1% and then let's say you lost two different trades, risking just 1%, you'll still be fine, right? It all depends. You'll still be emotionally fine. What I've actually noticed is that some traders starting with lower capital like $50 or $100, we want to risk more so that they'll be able to gain more. And it doesn't just work like that, okay? If you want to get more, all you need to do is increase your capital, okay? You need to increase your capital, not that you increase the percentage. If you want to get more, you increase your capital. Let's say if you're trading with a $100 account and you're risking 2%, you already know that your outcome will be small, okay? Your gain in each trade will be small. So all you need to do is increase your capital, not that you now increase your percentage from 2% to like 20% because you need more money, okay? It's not going to work that way. You're not going to last in the market. So you really need to understand the way the risk management and the capital preservation actually works. So the next thing I'm going to talk about is risk reward ratio. So this is where it actually gets interesting, okay? The risk reward ratio is let's say you're risking 2% of your entire portfolio. So as you can see here, we have risk reward of about 3-to-1 ratio, same as risking $80 to get to $40. Okay, so it means that if you're risking $80, which is 2% of your account, if you're trading with a $4,000 account, okay, that means if you're using a 3-to-1 risk reward ratio in that trade, meaning that if you win the trade, you're going to be getting $240. But if you lose the trade, you just lost just $80. Okay, so which means 80 times 3. So if you multiply 80 in 3 places, it's going to give you $240. That is how we have the 3-to-1 ratio. Okay, because there are some trades that once you lose, you're going to be losing your 2%. Then when you win the trade, you're going to be getting 3 times the amount. Do we even have 2-to-1 ratio? We have 5-to-1, 10-to-1. Okay, we even have 15-to-1 ratio. It all depends on you and how you've actually factored in your entry position, your invalidation, and then your take profits. Okay, so we're going to be discussing how that works in our next video, which is position size. But I really don't want to go into that at the moment. So as you can see, meaning if you win, you get 6%. Okay, so let's say you actually won this trade. That means you've actually gotten 3 times the amount, which is, since you're risking 2%, 2% times 3, which is 6%. You've gotten 6%, which is $240. And if you lose, you've actually lost just 2%, which is the $80. So if you don't understand, you can actually go through the video again in order to understand this concept. It's very easy. If you actually win, you're getting 6%, which is the ratio 3. And then if you lose, you're losing just 2%, which is the ratio 1. Okay, we have some trades that you actually have 5-to-1 risk reward. We have 10 to. It all depends on the trade. So when you understand this risk reward ratio now, you realize that we don't need to win all the trades. Okay, we don't need to win all the trades for us to be profitable. We can actually win 40% of our trades and lose 60% and still be profitable. So same goes to the sports account as well, the sport trading. Since you actually have 60% of your total portfolio in a spot account, so you know that one is at least less risky. Even at that, you still also need to know the different percentage you'll be allocating to different coins. Okay, you can actually always be in USDT if you're not trading at the moment, or if you're not buying any coin at the moment. Take for instance, you actually have $6,000, which is the 60% of your total portfolio on your sports, and then you want to purchase. You can purchase the less risky ones to be more of your portfolio, like Bitcoin. We already know that Bitcoin is less risky, so you can actually allocate more of your capital to it. While the more risky ones, like the altcoins and the low cap gems, you can actually allocate lesser percentage of your capital to them. Okay, so that's just how it works. As time goes on, you'll be getting used to it, and then you'll be knowing which one best works for you, and with more research, you'll be able to manage your portfolio by avoiding emotions and taking out emotions from the context. So we already said if you want to earn more, all you need to do is put in more capital. Okay. Once you already know the strategy you'll be using to avoid emotion, you don't need to go overboard or go against your strategy. Once you go against your strategy, you start making a lot of drastic decisions. You start making decisions that involves emotions, and whenever emotion is actually in place, you start making a lot of irrational decisions. Okay, so just like I said, don't make the mistake of increasing your risk per trade, because trading is a game of probabilities. So you might incur some losing trades too. Yeah, you can develop a strategy of taking profit at a certain percentage. Take for instance, you actually have $4,000 on your futures account, which is like 100%, and then you might decide that, oh, okay, once you get to 50% profit, okay, once you've been able to make 50% or 20% and all of that, then you want to take some profits. Then you can be doing that as time goes on. Okay, so let's say you have $4,000 and then you've been able to make 20% profit so far from the trading. Okay, you can always calculate your percentage. Then once you've been able to make 20%, you might decide to take out the 20% to as profits, because it won't be nice to always trade and then you're not enjoying the profit. Some might decide 50%, some might decide once I get to 100%, which is like you've doubled the account, you might decide to want to take profit at that point. So it all depends on you personally. Some might be 5%, some 3%. It all depends on your capital as well. Okay, some trading with a 100K portfolio might decide that, oh, okay, once he makes 5% profit, he's going to take it out to solve one or two problems and all of that. So it all depends on you. So finally, just like I said earlier, the reason for risk management is capital preservation and to be in the game for a long term. You don't want to play this game for a short term. There are a lot of opportunities that are going to show up in the market, a whole lot of opportunities. So we don't want to risk 30% of our entire account or of our portfolio into one single trade, because we feel like, yes, this trade is 100%, it's going to go our way and all of that. And then knowing that the market is actually a game of probabilities and then it doesn't go our way, then when other opportunities actually surface, we don't have any capital to actually invest into them. Okay, so we want to be in the game for a long period of time in order to maximize most of the opportunities that the market will actually be presenting to us. So that is all about risk management. I hope that is actually clear to you. If you don't really understand anything about it, you can actually leave a comment down below, and then you can always rewatch the video for more clarification. It actually helps. So that is all about risk management. Then I will see you guys in the next video.